It is completed. All right. So insurable interests are those familiar relationships that give justification in law for you to be able to insure somebody. If a relationship does not have insurable interest, then it's called STOLI. STOLI is the abbreviation, STOLI. It stands for Stranger Originated Life Insurance Policies. STOLI, Stranger Originated Life Insurance Policies. Again, I always say you cannot drive downtown, look under a bridge, and there are some homeless people looking sick. You say, come on, let me go and show you. You look like you're going to buy in 2 years and I can collect some money. So pi, for those people who don't understand what pi means, it means to die. I know you're either laughing because of what pi is or you're laughing because of the way I pronounce it. It's either of those two.
No, it's the present day norms. What do you call it? The Gen X kinds of Gen Z kind of language. So
Correct,
it wasn't
correct.
there when we were growing up that somebody dies, they say don't buy.
So I listened to that on social media and it sounds very funny. So
exactly.
That's why I use it to inject some humor into the class. So not to make fun of death. Death is not something to be made fun of, though we are all going to go that path in life. So, you know, yeah, that's our unavoidable destiny, you know, unless we are like Elijah or who was this other prophet that levitated straight, you know. So
you mean me or Enoch?
Enoch, you got it, Enoch, you know.
Because that's the way I'm going to go too. I walk with the Lord.
I like that. I like that. They say faith is the assurance of things not seen, right?
Yes.
But believed. So that's a good thing. So insurable interest, you need to have insurable interest to be able to insure somebody. And again, you need to have those familiar relationships. Settlements, policy owner sells a policy that is no longer needed to a third party. So when they talk about a policy owner selling a policy, and take down notes if you need to, you know, these things are very important. Take down. When they talk about a third party selling a policy, they are referring to what they call viatical settlements. Viatical settlements, VIATICAL, viatical settlements. And this is the arrangement where somebody has a policy. Let's say somebody has a policy and they have 12 to 24 months to pass away, but they want their money now. You know, they want their money now. And maybe these policies do not have accelerated benefits to them. So they can take this policy, go sell it with a third party. Say they have a $500,000 policy, they can go sell it for $480,000. Take their $430,000 now, live their life, settle their estate, and then when they pass away, the person who they sold the policy to, or the viator, can go to the insurance company and collect. So that viator becomes the owner of the policy. So for the third party buyer, people who arrange this kind of things are called viators. People who arrange this kind of things, they are called viators. VIATORS.
Please go back again. My ear is.
No, VIATORS. Viators.
Thank you.
Now they are talking there about the concept of assignment. Concept of assignment. Assignment is when you have a policy and you want to transfer the ownership rights in that policy to somebody else. That is called an assignment. So assignment basically means transfer of policy ownership rights. An assignment can either be absolute or it can be collateral. An assignment can either be absolute or collateral. These are all terms heavy with law. These are all legal terms. You have assignments, you have collateral assignments, you have absolute assignments, and you have something in law also called novation. Novation. Novation is when somebody comes and replaces you towards the fulfillment of a contract. But we're not talking about novations here. Assignments, collateral or absolute. What's a collateral assignment? A collateral assignment is when you assign only part of the rights, part of the ownership rights of a policy. That's called collateral. I.e., if you have a policy that's worth about $500,000, you go take a loan for $200,000, you assign an interest of $200,000 of that loan to the bank. That is a collateral assignment. Absolute is when you go take a loan for the total million, and the bank owns that policy. Now you transfer the rights of ownership to the bank. That's an absolute assignment. Okay. There's also the concept of employees receiving policies with a corporation or with any business. When you get employed, as part of the benefits of that group, the company can have a policy for its employees. What you need to remember for the exam, is that you don't own a policy when you work for a corporation. You do not own a policy. You own a certificate of insurance. There's a 100% chance you'll see this in the exam. A certificate of insurance. Who owns the policy? Who owns the master contract? The company does. The company does. What you also need to remember when it comes to policies that are group policies, these are policies that are issued by corporations for its employees, they call them group policies, is that you have a 30 or 31 days grace period. So if you lose that policy because you get fired from that job, the company lays off, somebody buys the company and chops off the employee, or the employer decides to close the company, and you no longer have that policy because you no longer have employment there. You have 30 to 31 days. For some states it's 30, for some other states it's 31 days to convert that policy from a group policy to an individual policy. For the exam, you also have to remember that when you do this conversion, the conversion is to a permanent policy, not a temporary policy. The conversion has to be towards a permanent policy. Also, for the exam, you have to remember that if you pass away while these 31 days have not elapsed since you left the company, you're fully covered. They'll pay you 100% of your death benefit, or they'll pay that money to your beneficiaries. Now, they might try to trick you into the exam by asking you a question. For example, somebody left the company, it was still within the grace period, and they passed away. Do they pay them the entire death benefit, or they pay them the entire death benefit minus 1 month premium? Since they haven't paid for 1 month and they've not been working with that company, do they deduct that 1 month premium from the death benefit? They might try to trick you like that in the exam. And just remember, they don't. They don't.
They don't, or they do?
They do not. They pay your entire death benefit. You also have to remember that in companies, if the employer is contributing 100% of the premiums to that policy, to that group policy, if they are paying 100%, then all the employees have to be covered. It's 100%. Everybody has to be covered by law. However, if the employees are contributing part of the premiums of that policy, means there's a co-pay towards your policy, then at least 75% of employees have to be covered for that policy to be effective. So there's contributory and there's non-contributory. There's non-contributory. Also remember that for group policies, when you lose your job or you get laid off or you get fired, for that 1 month while you're converting that policy into an individual/permanent policy, for that 1 month when you're converting that policy to an individual policy, they cannot ask you for proof of insurability. There's an 80% chance you'll see this in the exam. They will not require proof of insurability for you to get a permanent policy. So, all right, so let's talk about traditional IRAs. IRA stands for Individual Retirement Account. Individual Retirement Account. You can create an individual retirement account by putting pre-tax money into this account. And if you transfer money from your savings account into your IRA, they just give you about a $7,500 credit, or up to your contribution to a maximum of about $7,500 credit for taxes. This money is supposed to grow, and you can take it out after age 59 and a half for your retirement. If you have a 401k plan, you can also roll it from the brokerage company that is managing it into an IRA that you manage. Qualified retirement plans. We don't have too many questions on RothIRA.com. We just have to remember that the Roth IRA is a retirement contribution account where the money grows in the Roth, and then you can take it out tax-free at the end. But withdrawals in this case also do not have to begin at age 73. Now, pay attention to these types of plans. They usually come in the exam. Types of plans. Employer-sponsored qualified plans. So pay attention to them. Pay attention to them. HR10, KEO plans. These are self-employed people. So if you own your own business, you can devise a plan called a KEO plan. The IRS rules to devise in this plan, but just remember that KEO plans or HR10 plans are for self-employed people. SEP, which stands for Small Employer Plans. Again, these are plans that small employers can set up. You have simple or small employer plans of no more than 100 employees set up as IRA or as 401k plans. So simple plans, again, these are plans for small employers, but to qualify as a small employer to set up a simple plan, you do not have to have more than 100 employees. Okay. Okay, so you have 401k plans. I think most of us here have had 401k plans with companies. Again, they take money from your paycheck, they put it in this 401k plan, and the company pays a match into it. The company matches your 401k plan. When you're speaking to clients about rolling over their 401k plan into like an annuity, and they'll tell you, oh no, but you know, it's gonna grow for retirement and all of that. Just tell them that there are 2 people putting money into that plan, but there are 4 people that are gonna take money out. 2 people putting money, 4 people are gonna take money out. You're putting money, your company is putting money. Those are the 2 people contribution, but at the end, the federal government has its share, the state government has its share, you have your share, and every year the brokerage people who are managing that account take away about 4% of that money. So,
is this gonna be an exam?
No, this one is just a little bit, just educating you a little bit about the business.
Sure.
But there are 4 people, there are 2 people who are putting money in, 4 people who are taking money out. Okay. Taxation. So they'll ask you a lot of questions about taxations. Taxations for key person insurance, taxation for employer. Bonuses out there, all of that. Taxation when there's a benefit being paid to the key person insurance. Just remember that for taxations, say for key person insurance, and what is a key person insurance? A key person insurance is when the employer identifies an employee who is a critical employee to that business and insures that person, but it's the business that is the owner of the policy. For key person insurer is the business that is the owner of the policy. The employee is the insured, and the federal government allows this kind of policies to be created because You can have an employee who is very critical to the company, knows the network, knows how to train other employees, knows so many facets of the business. If something happens to this person and they die, you can almost shut down your business because it's difficult to train somebody to rise to that skill level. So the IRS allows employers to be able to insure this person so that if this person dies, they can use part of the money to retrain other employees and all of that. So that's key person insurance. But remember, the business is the owner, the employee is the insured, and then the business is the beneficiary. Business is the owner. Business is the owner. Employee is the employed. Business is the beneficiary. Also remember that the premiums that they pay for the key person insurance, the premiums that the company pays are not tax deductible. However, when there's a benefit paid, whether it's because you can have key person insurer that is attached to a death benefit, you can have also key person insurer that is attached to disability. In both cases, the premiums are not tax deductible, and the death benefit or the disability benefits are not taxable as well. So premiums are not tax deductible. Death benefit or disability benefit of key person insurance are not taxed. So remember that. So remember that you have policies that will accumulate cash. I really wanted to do this and then I just forgot. I don't like to do a class without running an illustration, because when you do an illustration and you refer to that illustration, people learn better. So let's just run a quick illustration here. Now for future classes, I might not go through these lectures. I might assign people to read these sections so that if they have any questions, they can ask, and then we'll go through the questions. Because one thing also is that when I'm lecturing and people are just sitting back and listening, people can feel sleepy, they can get tired, they can get bored. You know, I think the best way to learn are through the questions. So, yeah. So again, let's say instead of after.
Say Washington. Let's do Washington.
Yeah, I want to do after Desmond. The born again Gen Z person, you know. Desmond. So let's do it after Desmond. Let's say his name is Desmond.
It's spelled D-E-Z, not D-E-S.
Oh, pardon me, sir. Yes. Desmond. Let me give you a different last name, Abiola.
Okay.
Put some money in your pocket. All right. So let's say Desmond wants to leave a huge legacy. So let's give his family a $1.5 million policy here. Let's make it graded. Let's keep it target premium. Go to the next screen. Let's put his money in the balanced uncapped. 100% of it. Let's go to the next screen. We don't want to bother with income and distribution at this point. Let's give him critical illness. And let's assume Desmond took life and health license. So let's give the client long-term care. Let's choose a nice sandy beach. Then let's check these values. Let's go calculate. Okay, let's have a big, beautiful, colorful illustration. Let's scroll down to the numbers. Voila. So Desmond Abiola, no stranger to money, has a $1.5 million policy. Let me go to what that question was saying, or what that I wanted to explain. Cash value, the cash values of this policy are right here. You can see cash surrender. That's your cash growing. Now, they don't tax you on your cash growth except you take amounts that are more than the premiums you've paid. Otherwise, you're not taxed. But you can take more than the amount premiums you can take more than the premiums you've paid in by doing what? Just taking a loan from the policy. They don't tax you for loans. At age 20, he's put 306, 900. He has 419, 937. You can come take $350,000 here, no tax consequences, because they are taking it from your policy value via your death benefit. They are taking it from your policy value via your death benefit. If you don't pay it before you pass away, they'll just take it out of your $1.9 million death benefit here. So I want you to run this so that as I teach, I can go and show what we're talking about. Again, policy loans are not taxable. Interest on them that you pay are not tax deductible. Again, for like an index universal life, the interest you're paying on it when you borrow money from your policies, your personal bank, the interest they deduct from it or they charge you for that loan is just 2.75. You cannot get a 2.75 loan anywhere. And 2% comes back to you. As you're paying the loan back, 2% comes back into your account. The company keeps just less than 1%, 0.0075 for transaction cost. That's it. So educate people. They will actually be having a personal bank. You know, so again, always remember dividends that they pay into policy are not taxable. Dividends are not taxable. Death benefit is not taxable, but if you put the death benefit, say, into an annuity or in an investment account and it grows interest, the interest is taxable. So remember, for the exam, dividends are never taxable, interest is taxable. Dividends are not taxable, interest is taxable. Okay. Dividends are not taxable, interest is taxable. All right. So also remember that when policies pay dividends, there's a certain type of policy that comes that we need to be mindful about. They call them participating policies. Participating policies. There's a 90% chance you'll see this in the exam. Participating policies. Participating policies are policies that people have them with a certain type of insurer called mutual insurers. Mutual insurers, participating policies. These are companies that return unused premiums as dividends to their policyholders. So they pay their premiums throughout the year. At the end of the year, the total sum or the cumulative sum of premiums that exceed expenses is returned back to the policy owners as dividends. Because the law sees it as a return of premium, is not taxed. However, if they put this in the employee account with the insurance company and interest grows, the interest is taxable. The interest is taxable. So let's see, we're almost done with the explanations. We're almost done. We'll go to some questions. Rollovers. Rollovers are when you roll money from an account to another. For example, if somebody has a 401k plan, especially a 401k plan from an old employer, you can roll that money into an annuity. It's a tax-free distribution, rolling over from one account to another, because you're rolling the money over from a tax-preferred or tax-deferred account to another tax-deferred account. So they call that a qualified rollover. When you hear that word qualified in the exam, and you might see that word in the exam, when they say an account is a qualified account, just take the concept of the 401k plan and put in there. Concept of the 401k plan and put in there, which means growth year to year is not taxed. The taxation is deferred. You'll be taxed only at withdrawal, you know, and you move the money from one qualified account to another, there's no tax consequence. Okay. If you initiate a rollover from an account, it has to be completed within 60 days to qualify for the non-tax rollover. But if you distribute it, which means if you take out money, there's a 20% of it that is held as distribution. As well as if you move the plan to a trustee account, there are no withdrawals because it's seen as a direct rollover. Okay. Trustee account in this sense just means they see the brokerage company as a trustee. What are examples of these brokerage companies? Fidelity, Merrill Lynch, Charles Schwab, JP Morgan and Chase, Wells Fargo, all of these brokerage companies, they see them, that's what they refer to them as trustees. There's a term here, modified endowment contract, or MEC, modified endowment contract. Each policy has what we call a 7-pay test. A 7-pay test. Each universal life policy, a 7-pay test. If I click on menu here and scroll down, you'll see what they call MEC at the bottom left. MEC. MEC stands for modified endowment contract. And the 7-pay amount, 7-pay premium here, which for this policy, remember it's a $1.5 million policy, $91,625, is the maximum amount you can put in that policy. Remember here, each month you can make your premium for a $1.5 million for a 35-year-old, you know, Desmond Abiola. However, you can put more than that because these policies are actually personal bank accounts. They are a personal bank account. They have all the attributes of being a personal bank. If you own one of these policies, you'll be able to see. They grow you for phenomenal interest. The only difference is that your bank account will grow you money at less than 1% a year if you put money in a savings account in the bank. This is one of the policies I have for a client. See how much their interest growth was for last year, 12.16. Phenomenal, 12.16. And if you look at all of this growth that is happening here in this cash account or in this policy stuff here, it's estimated at 7.25. It's estimated at 7.25 growth a year, compounded growth. But as you saw in that statement, these accounts grow by far more than 7.25. This one grow by 12.16. So the average is going to be way more than what that illustration is showing, meaning you're going to grow cash really fast. So they are really a bank account, personal bank account. So you can put more money in it if you want, up to the 7-pay, which for that account is $91,000. If you have a policy with Transamerica and you put more than the 7-pay, they will not even take that money. They will return it to you. Because if you put more than the 7-pay, then it destroys all the tax benefits of the policy. That way you can take loans, you can do withdrawals and all of that. Then it's seen by law as just another investment. So if you are putting extra money, keep it below the 7-pay. I'm just looking at things that are very relevant for the exam. For Social Security benefits, you must understand that there's Social Security retirement accounts, there's Social Security disability, and then there's Social Security for survivors. Survivors is if your spouse dies and did not collect any Social Security, and they made more than you made in life, then you will collect their Social Security. You collect their Social Security. There's something which you might likely see in the exam. By the way, To collect Social Security disability, remember, you will see this in the exam. To collect Social Security disability, you must have been fulfilled the requirements in Social Security as having contributed fully to contribute to have Social Security disability. What is full contribution? What is considered full contribution into Social Security? Is when you, pardon?
Is that what it's 40 quarters, right?
40 quarters, correct. Contribution of 40 quarters, which means 10 years of work, because each year is 4 quarters. 10 years is 4 times 10 equals to 40 quarters to collect Social Security disability. Now you can collect Social Security retirement based on how much you contributed, even if you've not contributed for those full years. So, yeah. All right. This is our favorite part. Let's go to some questions. Let's go to some questions, okay? Let's go to some questions. Come on. Let's see if we get us some questions. Get us some questions. Okay. Let me just see if this will take me there. If not, I'll go through home. All right. I don't want to mess around through this method. Let me just go to home. That was chapter 4. Let's resume. Since we started doing that, it's going to want us to go through to the end. Oh, chapter quiz. We'll do that right here. Chapter quiz. So let's launch a new attempt. As I usually do to keep people's interest captivated, I just call people's names to help read the questions, and then we can see how we arrive at the right answer. Vivian, why don't you help us here with the first question here?
Okay. Question 1 of 15, it said, after a back injury, an insured is disabled for a year. His insurance policy carries a disability income benefit rider. Which of the following benefit will he receive? A, monthly benefit waiver and monthly income. B, percentage of medical costs paid by the insurer. C, yearly premium waiver and income. C, payments for life.
Okay. Okay. All right. So which one do we think is the answer here? Again, it's always good to start by eliminating the two that do not really jive with the question. Okay. There are at least a couple that we can eliminate. How long did they say this employee was disabled for?
For
12
1 year.
months.
So it
For 1 year.
It cannot be paid for life.
Excellent. We eliminate that. D is gone. Okay. All right. So does disability pay us for income or just for medical costs?
For income.
All
For
right.
income.
All right. Which answer has just medical costs?
B.
All right.
B.
So what do? We keep it or we eliminate it?
We eliminate it.
Good. So we are left now with A and C. So which of the following benefits will he receive?
I think A.
Monthly premium waiver and monthly income. Yearly premium waiver and income. Well, we want to think that they'll pay him monthly and not yearly, right?
Yeah.
Let's see if the examiners agree with us.
It's A, yeah.
We make sure that I can submit. I'll have to maybe reduce the font a little bit for it to give me the opportunity to
Go ahead.
Yes. Let's see. And you can always increase the font in your screen too.
Yes.
All right, let's submit.
Yeah, correct.
And that was right. So you see, there's a method to addressing the question and getting it right. Read the answer is mostly always in the question.
Yes.
If you understand the question right, you get the answer. By using the question to eliminate, and then you pivot to 2 now, and between those 2, again, you go back to the question, you'll get the right answer. All right.
Let me ask a question here in relation to Social Security. If there was a Social Security condition, how would we have seen it?
If it was Social Security, by the way, you don't start collecting Social Security until age 62. So it would have been different. It's a totally different scenario.
No, Social Security disability. I'm sorry, disability. Where somebody has been disabled for a whole year.
If somebody has been disabled for a whole year under Social Security, they will
disability.
Social Security disability, they will still receive disability for the period that they've been disabled, but it's going to be paid monthly.
Okay.
I've never seen any disability situation, policy-wise or Social Security-wise, where they pay you yearly.
Pay you lump sum for a year. That's true. That's true.
So, all right. So, Desmond, can you read this one for us?
Which of the following settlement options in life insurance is known as straight life?
Okay.
A, interest only. B, fixed period. C, fixed amount. D, life income.
All right. Very good. So there are different types of settlement income. I mean, settlement options with life insurance. And settlement options just mean there's a beneficiary there's an insured that passes away. Because that insured passes away, a whole pot of money is created. That's when families start fighting. When money is on the table, families start fighting. But there are options in which that money is going to be paid. For example, if you wrote your policy, there's a beneficiary, it's settled. There's no argument on who is going to get that money. But how is that person going to receive that money? Are they going to receive it lump sum? That's a settlement option. Are they going to receive it for a fixed amount? They receive it as a fixed amount, then depending on how big that policy is, it will now depend on how long that money is going to last. If they receive it fixed period, now these are settlement options I'm listing. Lump sum, fixed amount, which means they can say, okay, it's $1 million policy. I want to be receiving $10,000 each month. That is an example of fixed amount. You can also say, I want to receive it for 10 years. So it's $1 million. I want to receive it for 10 years. Again, they estimate how long that money will last for 10 years, and they start paying you an amount. So fixed, fixed period, you got it. And there's one that is also called life setting. Life setting. Another word for life setting is life income, which means they pay you for the rest of your life. You know, so they take that money, they put it in an annuity, and that annuity pays you a certain amount of money for the rest of your life. Okay? So they say, which of the following settlement options in life insurance is known as straight life? Which of those options rhyme the best with straight life?
I think it's D.
All right. And I think you're right. It's D. And Vivian, can you read that explanation for us?
Okay. So life income option, also known as straight life, provides the recipient with an income that they cannot outlive. It pays the benefit while the beneficiary is alive. However, the payment stops at the beneficiary's death.
Correct. Life income.
Life
Remember one thing about life income, and there's a 90% chance you'll see it in the exam.
Yeah.
Remember this about life income.
Mhm.
It has the potential for the highest amount of monthly payments.
Protection.
Life income has the potential for the highest amount of life income payment. They'll give you a question and they'll say, which of the following has the potential for the highest amount of monthly payments? Remember, the answer is life income. The answer is life income. Oluwa Tosin. Oluwa na God, always be thankful. If you
Okay.
get you, no get you. Oluwa, are you there? Go ahead and read that one for us. Sorry that I'm singing your name, but the song just came to my mind. I had to sing it.
That's good. An insured has chosen the joint and 3/2 survivor settlement option. What does this mean to the beneficiaries? A. One of the beneficiaries will receive 1/3 and the other will receive 2/3 of the proceeds when the insured dies. B. The beneficiary will receive 2/3 of the lump sum upfront, and the remaining 1/3 will be paid over time. C. The surviving beneficiary will continue receiving 2/3 of the benefit paid when both beneficiaries were alive. D. The beneficiary will receive 2/3 of the total benefit, with the final 1/3 payable when the first beneficiary dies.
Okay. All right. So good question here. And I don't know what the answer is. So we are going to try to figure it out together. But they said the insured has chosen the joint and 2/3 survivor. We stop right there. We know they are talking about joint and survivor. What is joint and survivor? They will pay a certain amount of money to both couples while both of them are living. But when one dies, they will pay a percentage of what they were paying on the original amount to the other person until the other person dies. So joint and survivor will pay to both people while they're alive. What is the opposite of joint and survivor? Joint life or joint. Joint, they'll pay only to one person. No, they'll pay to both persons while both persons are alive. But when one person dies, the payment stops. So there's joint and there's joint and survivor. But here they say, what does this mean to the beneficiaries? So right here, who will receive 2/3 of what they were paid? Is it the first person or the second person?
The second person.
I think the second person.
Second person. So which amounts here have the first person or the two people receiving 2/3? Because through this, we're going to eliminate like 2, you know. Or after diagnosing the answers, who wants to just zoom in and tell us what they think the answer is here?
I think I should know this answer.
Okay.
I've forgotten my brain.
All right.
This answer.
Okay. So, anybody want to take a stab at this?
Benefit received to
Okay.
that without benefit. Why did content?
Hey, hello, I want to try. This is Clara.
All right, Clara, let's go ahead and try.
I'll go with C.
All right, Clara says C. All right, and that is great reasoning. Clara, if you fail, I think both you and I are going to fail. So I want to stake myself on what you just said.
Okay.
So they say C says the surviving beneficiary will continue receiving 2/3 of the benefit paid when both beneficiaries were alive. So they were paying the beneficiaries an amount, say maybe $1,000 a month when both couples were alive. Remember, this is a settlement option. That settlement option is called joint and survivor. But within that settlement options, you have contractual details where they will pay 2/3 of what they were paid when both people were receiving the money. So if both people were receiving $1,000, then when the first person dies, they will continue to pay $666, which is 2/3 of that 1,000 until the second person dies, and then payment stop. So let's see if Clara is right. See, now that we get to whether is right, I want to put it all on Clara, not on me. So, and Clara was right.
It's correct.
I was right.
We have a problem with that question.
What did you say, Tina?
I've been always had a problem with that. It's confusing.
Does
Let's
the
analyze
explanation
it
make
again.
sense?
Yeah, it makes sense now. So
All right.
the survivor beneficiary will continue receiving 2/3 of the benefit
Correct.
paid when both beneficiaries were alive.
Correct.
Oh, okay.
Correct.
I didn't know. Okay.
They say if you know, you know. But if you don't
Yes.
know,
Yeah,
now
that's why I
you
kept
know.
quiet.
All right. So 4 of 15. Let's see. Clara, you want to read this for us?
Yeah, I can read it. What is the purpose of a free look period in insurance policies?
But everybody, like say, laughing.
I think that is everybody knows this now.
Yeah.
All right. Well, let's have somebody say it then. What's the answer?
Should I say it?
Yeah, go ahead.
I think it's A.
All right.
It was to ensure the
All right. So free look policy, and you're right. Says it allows the insured to reject the policy with a full refund.
The full
Payment.
refund.
Refund.
In most states, how long is the free look period?
10 days.
10
10
days.
days.
10 days. In most states, it's 10 days. So great. We will start making sure that before we come to this class, people register for their exam. Because what I'm seeing is that you guys are very smart. And there's a lot of knowledge that we share in this class. You learn both from me and from the other participants. If you just register for the exam within the next 2 or 3 weeks, you will push yourself to go take this exam and pass. You will push yourself.
I registered already.
When are you taking it?
I was supposed to take tomorrow, but I rescheduled for the 26th.
And what state are you in?
I'm in Abilene, Texas.
And who is your SMD?
Miss Estella Musi.
All right.
Estella.
That's good. That's
our
good.
mom.
Yeah.
That's good. All right. Let's go to the next question here. Abraham, if you are there, can you read this one? How about Lola? You want to read this one for us?
The life insurance policy clause that prevents an insurance company from denying payment of a death claim after a specified period of time is known as one. As A, incontestability clause, B, reinstatement clause, C, misstatement of age clause, D, insurance clause.
Okay.
A.
It's A. The answer
All
is
right.
A.
So a lot of people are studying and they know this very well. The incontestability clause. And how long usually does the incontestability clause last?
2 years.
Okay. How many years?
2 years.
2
After
years.
2 years. 2
Usually
years.
2 years in most
2
states.
years.
Mhm.
All right. What is an exception to the incontestability clause?
Name stating
No.
the date of birth.
No.
This so date of birth, yes. Date of birth is the only exception
Mhm.
to the incontestability clause. Now remember, the incontestability clause says there's a period of time after you write the policy, usually 2 years, that the life insurance company can contest payments when there's a loss if you misstated something in the policy. If there was a material misstatement, they will challenge the payment to it. However, if the policy has been in existence past 2 years, then you've gotten into the incontestable period, and they cannot contest payment except if you misstated your age. Tina, tell us what they will do if you misstated your age.
Reduce the
They will adjust the
benefit.
payment to
reduce the
align with
death
the
benefit.
Benefit.
I see a lot of passes. You guys are going to go past this stuff. You guys are going to go past this stuff.
Wish me luck. I'm taking mine this weekend.
All right. I'm very happy to hear that. Very happy to hear
Wish me
that.
luck, sir. And do it.
Florence, I know you're listening. Can you read this one? Florence, are you there? Desmond, can you read this one? Since Florence is a little...
The sole beneficiary of a life insurance policy dies before the insured. If the policy owner fails to change the beneficiary before the insured dies, the proceed of the policy will go to A, the beneficiary's estate, B, probate, C, the state, D, the insured estate.
Okay. So this one is a one. This question is what I call a low-hanging fruit. You answer it quick and you move to the other ones.
Yeah,
and what's the answer here?
D.
D now to go back to the insured estates.
Correct. You pick it and you run. There's no reason for probate. There's no reason for it going to the state. There's no reason for the beneficiary, because the beneficiary has no rights until the insured passes away. So, but the beneficiary died before the insured died, which means the beneficiary's rights go up in smoke. So we answer that, and we are right. All right. Miss Karen, if you're there, can you read this one? Miss Karen, if you're there, can you read this one? Miss Karen, if you're there, can you read this one? If not, Miss Geraldine, can you read this one? Miss Geraldine, can you read this one? Okay, we'll go back to... All right, go ahead.
The following...
I can read. Okay.
She's there.
Reading.
Go ahead.
Okay. Which of the following named beneficiaries will not be able to receive the death benefit directly from the insurer in the event of the insured's death? A, the wife of the deceased insured. B, a minor son of the insured. C, a business partner of the insured. D, the former wife of the deceased insured.
Okay. Again, this is another low-lying fruit. And what's the answer here?
B.
Correct.
Minor cannot receive.
Correct. Very true. Very true. It says, because the minor does not have the legal capacity to release the insurer from further obligation, benefits normally have to be passed through a guardian
Then or trustee.
Yes. In court, they call this the guardian ad litem.
Ad litem. Ad litem.
Ad litem, okay.
All right.
Ad litem.
We are learning legal words.
Correct, correct. Tina, you want to read this one for us?
Okay. The two types of assignment are A, absolute and collateral. B, complete and partial. Absolute and partial. A is the answer.
All right. Tina answered it right away.
No need of wasting time. We just learned it, right?
Correct, correct. So as you can see, absolute and collateral, I did explain this in my explanation.
Yes, you did,
so,
yeah.
Yeah, if anybody does not understand what absolute and collateral is, they can raise their voices and I'll explain.
Oh, yeah, can you explain for me, please?
Okay. Clara, yeah, I know you joined a little late. So let's say you have $1 million policy, right, Clara?
Yes.
And you go take a loan from the bank for $200,000. And you assign a $200 interest in that life insurance policy to the bank. Should you die without having paid the bank, right? That is a collateral assignment. An assignment here is a transfer of rights. So you've transferred $200 of that policy to become now a lien on that loan. Okay, collateral assignment. Now, if you have a $1 million policy and you go take a loan for $1 million, right?
Yeah.
And you assign that $1 million policy as collateral for that loan. Now you assign the total rights in that policy to the bank, right?
Yes.
That is an absolute assignment.
Okay.
All right?
Yes.
Is it as clear as mud now or as clear as water?
It's as clear as water.
All right, that's good. That's good.
Thank you.
All right, you're welcome. You're welcome. Number 9 here. Let's go back to Desmond. Desmond, can you read this one for us?
Which is not true about beneficiary designation? A, trust can be valid beneficiaries. B, the policy does not have to have a beneficiary named in order to be valid. C, the beneficiary may be a natural person. D, the beneficiary must have insurable interest in the insured.
All right.
The answer is D.
All right. The answer is D. Correct,
D.
Vivian?
Yeah.
D, yeah.
All right. D as in David.
Yes.
D for Desmond.
D for Desmond, right? D for Desmond. Yes. So, but there's something we need to remember. Okay. Let's reread. They say, which is not true about beneficiary designation. What we need to pay attention to is what is true about beneficiary designation.
Yes.
So A says trust can be valid beneficiaries. True. So a beneficiary does not need to be a natural person. B.
It's true.
The policy does not have to have a beneficiary in order to be valid.
That is true.
Pay attention to that B. You might see it in the exam. C says the beneficiary may be a natural person. True. Maybe. So they say D is the answer. Let's submit. And that's right. Yeah. All right. No need for an explanation here. Let's go to the next one. 10 of 15. Vivian, you want to read this one?
What is the other term for the cash payment settlement option?
Okay.
A, lump sum. B, face amount. C, principal amount. D, proceeds.
All right. What
I
do
think
we...
it's the answer is face amount.
Okay. Let's think again.
What is the other term for the cash payment settlement option? Principal amount, lump sum amount, face amount, proceeds.
All right. So remember, I went through the various settlement options, okay?
Yeah.
Fixed payment, fixed amount,
Principal amount.
straight line,
It's
Yeah.
A.
lump sum.
Mhm.
Lump sum is when it says you have a death benefit and they pay you that benefit complete. They pay you, say if the death benefit is 2 million, they pay that 2 million into your account. That is a lump sum payment. So which answer do you think is the answer to that question?
A.
So
All right.
cash payment will be lump sum then.
Correct.
So if it's not cash payment, so what will it be?
Okay. It could be fixed amount, which means instead of paying you the entire lump sum, they put that money in an account like an annuity, and they say that annuity will pay you a certain amount every month. Or they can say, the owner might have designed that policy to say, upon my death, put the money in an annuity, let that annuity grow for 5 years. After those 5 years, you start paying them a fixed amount. Fixed amount will be they pay a certain fixed amount, but then the amount of that account or that death benefit plus growth in interest will determine how long those payments will last. So it might be $1 million policy. They say they want you to be paid $15,000 a month. The size of that policy will determine how long it lasts. It can
So
be
first, yeah, okay. I want to ask face amount here. What will face amount be in an insurance policy?
All right, excellent. If I write you a policy and the initial death benefit is called the face amount. See this policy we wrote here for Desmond Abiola. Insurance coverage, initial face amount right here, 1.5 million. So that's the initial death benefit. Now, when you die, the death benefit is not going to be necessarily 1.5 million. That's why they say the initial face amount. Why is it not necessarily the 1.5 million? Let's say you die at age 80. How much is that death benefit now?
I'm not seeing. Okay, 3,341,064.
Correct. Which was the initial face amount of 1.5 million plus the cash growth over all of these years.
Okay.
Does that make sense now?
Yes.
Yes.
But,
right.
what's the difference between principal amount and the lump sum amount?
They threw this principal amount here just to confuse you.
There's nothing like principal amount.
Well, there's something like principal
What
amount.
is it?
Principal amount. Let me explain what principal amount is.
Please.
Principal amount is when you have a disability policy.
Oh, okay.
And they say the principal amount always occurs in accidental death and disability.
Okay.
Yeah.
So in accidental death and disability, the total amount they can pay you when you die is referred to as the principal amount.
Okay.
But remember, that policy is accidental death and disability.
Okay.
So if it's a disability, let's say you lose your eye or you lose your leg,
it should be capital amount.
The capital amount. It's a percentage of the principal amount.
Okay.
Does that make sense now?
Okay, now I understand. I got confused with the lump sum and principal.
That's why we're here.
Yes,
any question you have to ask, proceed.
Yeah.
So upon the death of insured, the contract is designed to pay the proceeds in cash called lump sum.
Lump sum.
As a cash settlement option.
Okay.
All right. Let's go to the next one. Clara, you want to read this one again?
Yeah, I can. Non-forfeiture values guarantee which of the following for the policy owner? A, that the policy premiums will never increase. B, the cash value will not will not be lost. C, the death benefit will be paid in a lump sum. D, the dividends will be paid annually.
All right. Like I always say, the answer is always in the question. There's a key word in that question that tells us what the answer is.
Non-forfeiture.
Non-forfeiture.
Correct. And so what is the answer?
That's a guarantee now.
It can never be forfeited.
The answer
Correct.
will be B.
B, yeah.
The
That's
cash
good.
will be lost.
Correct. So what are the other known forfeiture options? They include, here they talk about, they include reduce paid up, which means you have cash in that policy. They will reduce the size of that policy and pay it off with that cash. Reduce paid up. Another known forfeiture option is extended term.
Extended term, okay.
Which means they'll use the cash in that policy to extend the term in that policy, and then they pay it off. Another known forfeiture value is paid up additions.
Paid up addition.
Paid up additions. And so you have a policy like for $1 million, the cash in that policy can buy additional policies. For $1 million, they'll use that cash to pay off the new policy that they are adding. So reduce paid up, extended term. What did you want to ask, Tina?
I wanted to say, okay, what's the difference with pay up option and paid up addition?
All right. Paid up option is when you have a policy with an initial face value. They use the cash to pay off the premiums for that policy. That is paid up.
Okay.
So they are not adding anything.
Okay.
Paid up addition is when they use the cash in that policy to add the face value, and then they pay it up.
Okay.
Is it clear now?
Yes.
All right. So we hit submit. There you go. See, because permanent life insurance policies have cash values, there are certain guarantees built into the policy that cannot be forfeited by the policy owner. Non-forfeiture values give the insured the right to the cash value, even if the policy lapses or is surrendered. All right. Next one here. Vivian, can you read this one for us?
Okay. All right. An insured pays an annual premium to his insurer. In return, the insurer promises to pay benefits in accordance with the terms of the contract. This is called consideration. Okay. A, utmost good faith. B, acceptance. C, consideration. D, conditions.
All right.
C is the answer.
C, consideration.
Consideration. Excellent. Excellent. Again, what is consideration? Consideration is what we give up in material substance to bind the contract. What we give up in material substance to bind the contract. What does the client give up? Payment of premiums.
Premium.
There's a second thing that that client gives up to bind the contract. It's both premiums and what? There's a second thing.
Utmost good faith.
Well, there's utmost good faith. Faith is an inherent precondition to the contract, but there's something else that that client gives up to, in addition to consideration.
Consent.
Pardon?
Is it consent?
No. The representations you put on the application, what you put on that application, that is also considered part of consideration.
Okay.
What is the consideration on the part of the insurance company?
That they will pay you.
To pay if there's a loss. To pay if there's a loss. So consideration is the answer here. We submit, and we're right.
Okay.
We're right. Vivian, you want to read that explanation?
Okay. Consideration is the value offered by the insured to the insurer and vice versa. The insured makes accurate statements in the application and remits premium payment. In exchange, the insurer provides benefits as stipulated in the contract.
Correct.
Um,
Go ahead, Desmond.
In the interest earned on policy dividends is A, taxable,
Mhm.
B, non-taxable,
non-taxable.
C, tax deductible, D, 40% deductible, similar to a capital gain. The interest earned on a policy dividend is it should be A.
Taxable.
A,
I think
taxable.
A is taxable, the interest.
Interest is taxable.
The interest earned on dividends, yes, is taxable.
Mhm.
Are dividends themselves taxable?
No.
No.
All right. Very correct.
Mr. Ghana, I'd like to take permission. I have somewhere to go to.
You are
Oh.
giving, before you leave, Vivian,
Mhm.
when are you taking this exam?
I plan to take it on Friday, but I don't know.
Have you already registered?
No, I'm not. I haven't registered, but I plan to take it nothing less than Tuesday.
All right.
But I plan to take it on Friday. If it passes Friday, Tuesday. I've been doing some practice exams.
Okay.
So I've done quite a lot of it. I think I have a little bit of confidence that I'm going to pass.
Vivian, I'll call you and let's make sure you register for that exam.
Okay.
I'll give you a phone call.
Okay, thank you.
All right, take care.
Everybody, bye.
Bye. Good luck.
Thank you.
All right. Next question here. Olua, you want to read this one for us?
According to the entire contract provision, what document must be made part of the insurance policy? A, outline of coverage. B, agent's report. C, buyer's guide. D, copy of the original application.
Okay. 100% you see this question in the exam.
D.
And that's right. Copy of the original application is part of the entire contract provision. So cram this, you will see it in the exam. Which is true. All right, next question. 15 of 15. Geraldine, you want to read this one?
Which non-forfeiture option has the highest amount of insurance protection? A, conversion. B, extended term. C, decreasing term. D, reduced paid up.
Okay. Which one do we think is the answer here?
Extended term.
B, extended term, yeah.
Let's go with the extended term and see if Ms. Clara is right.
Yeah.
That's correct.
Mm-hmm.
The extended term non-forfeiture option has the same amount, same face amount as the original policy, but for a shorter period of time. We submit 100% right.
Oh, we had passed. We did it.
I've taken the live.
Go ahead, Clara.
No, I just want to say I've taken the life insurance test like twice. I just like the feeling. I have like it's on a 70, right? You have to have a 70%, but I keep having like 65, 62, and it's just I don't know, it's pissing me off. But now I'm about to take the life and health, which is more. It's harder. I think it's harder than the life itself.
Is this class making a difference?
It is. It sure is. But like I'm able to answer the questions because I know some of the things already. Like I said, I already took the exam, but I failed the life insurance.
In this business, Clara, we say it's okay to fail, just fail forward.
Yeah, and go, yeah.
fail forward.
So what's the passing grade?
It's a
Seven.
70%.
70. Okay. Okay. I will try. See what will happen.
Here, I'm going to go straight to the questions. So
Okay.
go and your assignment, part of your assignment is read the chapter on retirement and other insurance concepts. I'm going to go straight to the questions
Exactly.
because there are a lot of things that I'll be able to explain here in the questions that will capture the notes. So,
That's true.
all right. 1 of 15. Olua, can you read this for us?
Okay. Which of the following is an IRS qualified retirement program for self-employed? COG plan A, B. Are you hearing me?
Yes,
Yes,
we're
sir.
hearing you loud and clear.
Okay, B. 401k plan. C. Buy-sell agreement. D. Split dollar.
Okay.
A.
It's A.
Yeah.
All right.
the
Geo
A-
plan.
A
We saw
focus.
it in the previous chapter, right?
Yes.
Geo plan. Self-employed individuals. We're correct. And they say Q of HR 10 plan allows self-employed individuals to establish tax-favored retirement plans for themselves and their eligible employees. So we go to this one. You have to do a little arithmetic here. A little arithmetic. Geraldine, can you read this one?
An insured decides to surrender his 100,000 whole life policy. The premium paid into the policy added up to $15,000. At policy surrender, the cash surrender value was $18,000. What part of the surrender value will be income taxable?
Okay.
I think, should I say,
Go ahead.
I think it's D. That's 18,000 minus 15.
Correct, which is 3,000.
3,000. Yeah.
And the concept is that they will only tax you if you take out more than what you've put in.
Mm-hmm.
Correct. So 3,000. Very true. Submit, and that's right. All right, next one. 3 of 15. Desmond, you want to read this one?
A corporation is the owner and beneficiary of the key insurance life policy. If the corporation collects the policy benefit, then the benefit is subject to the exclusionary rule. B, IRS has no jurisdiction. C, the benefit is received as taxable income. D, the benefit is received tax-free.
Okay.
The benefit in an insurance policy is tax-free.
That's D.
D.
Okay.
Yeah, D.
Yeah.
We just talked
So
about
again,
it, right?
we're talking about key person insurance here. The benefit, who receives the benefit?
The company.
Employer.
The company.
That's
The
correct.
the corporation or
The corporation.
the employer is the owner and the beneficiary.
Correct.
Yeah.
So should a key person die, the benefit is treated as a reimbursement to the business for loss of services from that key person. All right. 4 of 15 here. Clara, you want to read this one?
Oh yeah, I can. All of the following are true of a key person insurance except A, the employer is the owner, payer, and beneficiary of the policy. B, the plan is funded by the permanent insurance only. C, there is no limitation on the number of key employee plans in force at any one time. D, the key employee is the insured.
Okay.
So I think the answer is D, the key employee is the insured.
And except.
Okay. Again, read the question very carefully. It says except.
Except the key employee is the insured. Am I right? I'm wrong.
No,
No.
B is the answer.
Okay, the key employee is the insured. Yes.
So B is the answer. The plan is funded by permanent insurance only. It can be funded by any type of
correct. That's correct. So for a key employee insurance, it does not necessarily need to be funded by a permanent insurance policy. It can be funded by term, whole life, index universal life, any of those. So that's the exception.
Oh, okay. So it's B.
Yep. Again, let's pay attention. They say the employee is the owner, payer, and beneficiary of the policy, which is true.
Yeah.
And then there is no limitation on the number of key employees in force at any time, which is true. So submit, and we got it right. All right. Let's go to the next one. Number 5 of 15. Karen, can you read this one? If you're there. Miss Karen, can you read this one? If Miss Karen is not there. Abraham, can you read this one?
The traditional IRA withdrawals prior to what minimum age are considered early and are subject to penalty. And IRA withdrawals prior to the minimum wage is 59.5.
Correct. Yep. And that's correct.
All right.
So in IRA, you must not take your money before age 59.5, or else you're subject to a 10% additional tax. Okay. Next one, Elizabeth, if you are there, can you read this one? Elizabeth, if you are there, can you read this one? Elizabeth, thank you.
Okay. All of the following will be different between qualified and non-qualified retirement plans, except A, taxation of contributions, B, IRS approval requirements, C, taxation on accumulation, D, taxation of withdrawals. The following will be different.
All right, so they say all of the following would be different. It's a very tricky question. So the best way we can answer it is by analyzing each one of them to see if they are similar or if they are different. Okay. Let's look at taxation on contributions. All of them would be different. Taxation on contributions. Where for qualified plans, the contributions have not been taxed. For non-qualified plans, the contributions have already been taxed. So there's a difference. So we eliminate that. IRS approval requirements. IRS approval requirements. For qualified plans, there are IRS approval requirements.
Yeah.
For non-qualified plans, there are no IRS approval requirements. So there's a difference. We chunk that out. C, taxation on accumulation. Taxation on accumulation. Let's skip C and go to D. Let's skip C and go to D. In D, for qualified plans, remember the entire money has not been taxed yet. So they are going to tax you on everything that you're taking out because nothing has been taxed for qualified plans. For non-qualified plans, the amount that you brought into the annuity has already been taxed. So when you're taking out money, they are going to tax you only on the growth of that annuity.
The accumulation.
The accumulation. They're going to tax you only on the accumulation. So there's a difference. So let's look at C now. Let's go back to C. Taxation on accumulation. Well, we've already eliminated A, B, and T. Let's see why this one is similar. Let's see why there's no difference. In C, while the money is growing, is it taxed? For both qualified and non-qualified? No.
When you withdraw.
Neither of them is taxed while it's growing. Whether it's qualified or non-qualified, while both accounts are growing, there are no taxes that are paid. Taxation only occurs at withdrawal. So that is, they say all of the following would be different between qualified and non-qualified retirement plans, except
taxation of contribution.
Taxation on accumulation. Is there anybody who thinks any differently here? Anybody who thinks any differently? All right. Let's see if we are right. Correct. So if you go through that process of reasoning, you'll arrive at the answer.
Taxation of
all right. They say taxation on accumulation is deferred in both types of plans. The rest of the characteristics would differ. All right. Let's keep moving. Let's keep moving. Lola, if you are there, can you read this one? Lola, if you are there, can you read this one?
Two attorneys operate their practice as a partnership. They want to start a program through their practice that will provide retirement benefit for themselves and 3 employees. They will likely choose A, HR 10 Cure Plan, B, Section 457 Deferred Compensation Plan, C, 403B Plan, and D, 401K Plan. I'm thinking A is the one for self-employed.
Correct. Correct. I think you're right. HR 10 Cure plans are plans for self-employed people. Let's see if we're right.
Yeah,
you're very right.
Yeah.
You're very right. I'm very impressed at how much you guys have mastered this material. I think almost all of you are ready to go take this exam within the next 2 to 3 weeks. So.
Because you explain it very well, so that's why.
Well, also you guys are making a good effort. You can explain all you can, but if the people are not making effort, it's gonna be like a boat on dry land or a balloon without air. It's not going anywhere. So, all right. Oluwatosin. Can you read this one?
Under a simple plan, which of the following is true regarding taxation? Which of the following is true regarding taxation on both contributions and earnings? Taxes must be paid in full. They are tax deferred until withdrawn. Employers' matching contribution can be 50% of employees' salary. 75% of employees' contributions are taxed.
Okay. We want to eliminate some of those real quick. Which ones do we eliminate? D says 75% of employees' contributions are taxed under a simple plan. Is that true?
Yes, I think so.
I beg to differ.
I'm not too sure.
Yeah. Remember, that 75% comes in group policies when the company, when the employer is paying, when the employees are paying a co-pay, then 75% of them have to be covered, at least 75%. But in simple plans, they say which of the following is true regarding taxations on both contributions and earnings? 75% of employee stuff is not taxed. So we kick that out. It's not true.
Okay.
C says employees matching contribution can be 50% of employees' salary. Employees matching contribution can be 50% of it. Is that true or false?
That's false.
Yeah, because there's a limit on how much money you can put in your 401k plan or simple plan. Usually it's up to the limit of about $23,500 a year. So if you're making say 100,000 or 200,000, can the company put $100,000 of as your contribution into the plan? No, it's over the $23,500 maximum. So that's not true. So we are left with A and B. A says taxes must be paid in full. B says they are tax deferred until withdrawn.
Yep.
B.
Let's see if we're right. And we are.
Yeah, right.
Taxation is deferred on both contributions and earnings until funds are withdrawn. Let's see the next one. Let's see the next one. 9 of 15. Tina, can you read this one for us?
In group life policy, a certificate of insurance is given to each insured person, the group sponsor, the insurance producer, the policy holder, A, each insured person.
That's true. Yeah. Who is the policy holder here in group insurance?
The
employer.
The employer.
Correct. So a certificate of insurance is given to each person that is insured. Very true. All right. Number 10 here. Lola, are you there to read this one?
I'm right here.
All right, go ahead.
What is the main purpose of the 7-pay test?
Okay.
A, it guarantees the minimum interest. B, it determines if the insurance policy is a MEC. C, it requires level premium payment for 7 years. D, it ensures that the policy benefits are paid out in 7 years.
Okay.
I know it's between C and D. You explained this last week.
Yeah, I think it's
It ensures that the policy.
C.
No, I think it's C because we say if it's not, it must not be more than a certain amount of money. If not, you will lose the benefit of that particular.
Let's go back here. 7-pay test. For this policy, the 7-pay is 91,000. If you put over 91,625 here, it will become a modified endowment contract, a MEC, a modified endowment contract. Again, this policy is a $1.5 million policy. Your monthly premiums are $1,275. Target premium, which is 1,275 times 12, which is a yearly premium of $15,345. But there's a 7-pay test of 91,625. If you put more than this, it destroys the IRS benefits to this policy. It becomes a modified endowment contract. Let's go back to the question. What's the answer?
I'm still going with C. It ensures level premium. I don't know.
I'm going with B.
Maybe I'm confusing.
It determines
say
if
it's
the
B.
insurance policy is a MEC.
That's true.
It determines if the insurance policy is a MEC.
It's a modified endowment contract. True. Yeah. So,
but my question is, if you pay more than so that's just within 7 years.
correct.
It can be more than that in 8-10 years. Correct.
No, the 7-pay test is just the amount where you cannot put more than that amount in a year.
Oh, okay. No,
You
within
cannot
the
put more
7
than that
years.
amount
Okay.
in a year. So the 7-pay test will determine if your policy stays an insurance policy or if it becomes a modified endowment contract.
Mhm.
Okay.
Yes.
Thank
or
you.
It becomes a modified endowment contract. So, so let's pick that answer. Sorry for my delay. Let's pick that answer and submit. And that's correct. That's correct. Lola, I want to go ahead and read that explanation to us.
Okay. The 7-pay test determines whether an insurance policy is overfunded or if it's modified endowment contract. In other words, the cumulative premiums paid on the first 7 years of a policy must not exceed the total amount of net level premiums that will be required to pay the policy up using guaranteed mortality, cost, and interest.
Okay. Very true. Very true. We're getting towards the end. We have 4 more questions to go, or 5, counting down. We have 5 to go. Desmond, you want to read this one?
Sure. What is the primary purpose of 401k plan? A, education funds. B, to receive dividends over a certain period. C, life insurance distribution. D, retirement.
Retirement.
I would think it's retirement.
Retirement, of course.
All right. Let's see. Submit. Bingo. Yeah. Bingo. Well, no need to explain this. I think it's very self-explanatory.
Yes.
Let's go to 12 here. 12 of 15. 12 of 15. Miss Geraldine, can you read this one for us? Miss Geraldine. Miss Geraldine.
Who is the owner and who is the beneficiary on a key person life insurance policy? A, the key employee is the owner and the beneficiary. B, the employer is the owner and the beneficiary. C, the employer is the owner and the key employee is the beneficiary. D, the key employee is the owner and the employee is the beneficiary.
So I'll go B.
D.
B.
B as in boy. B as in Bombay. B as in Bangladesh. And B as in correct. With the key person coverage, the business, the employer is the applicant, the owner, the premium payer, and the beneficiary. You guys are so ready to go past this exam. So ready. Miss Florence, can you read this one for us? Miss Florence, are you there? If she's not there, Mr. Abraham, are you there? The father of many, Abraham, are you there?
Yes, sir, I'm here.
All right, let's read this one.
Okay. Which of the following is the best reason to purchase life insurance rather than an annuity?
Okay.
A, to liquidate a sum of money over a lifetime. B, to liquidate a sum of money over a period of years. C, to create an estate. D, to create regular income payments.
Okay.
I think it's D.
Okay. Which of the is the best reason to purchase life insurance rather than annuity? There are 2 reasons to buy life insurance. 2 main reasons.
I say it's A. I think. I'm
No,
not sure.
it's C.
I think it's C.
It's C, to create an estate.
Estate.
1, to create an estate. And what is the second reason to buy life insurance?
Income.
Income.
to transfer risk.
Transferring of risk, yes. Transferring of risk.
How? Life insurance.
You transfer the risk from the person to the insurance company.
Okay.
Yep. Creation of an estate and transfer of risk.
Okay.
That's correct.
Mhm.
With insurance, the death benefit creates an immediate estate should the person die.
Mhm.
Okay.
Immediate estate. Okay.
14 or 15 here. Geraldine, can you read this one again?
Which of the following statements about group life is correct? A, the premiums are higher than in an individual policy because there is no medical exam. B, the cost of coverage is based on the ratio of men and women in the group. C, the policy can be converted into an individual term insurance policy. D, the group sponsor receives a certificate of insurance.
Okay. Which one do we think is the answer here? Which of the following statements about group insurance is correct?
I can say
C.
The B.
the B. I can take the B.
All right,
B?
we have several B's.
The group
I
swap
said D is out because it's individual.
It is individual.
The cost
I-
of coverage is based on the ratio of men and
I says
women
B.
in the
No, I think
group.
it's C. I'll go with C.
All
The
right.
The
cost of
policy
coverage is
can
based
be-
on age. I don't
think
think
it's
it
C
has
as
to
well.
do with
Okay.
gender.
So for those who think it's C, let me explain this.
Okay.
When you convert a group insurance policy, you don't convert it to term. It has to be to a permanent policy.
Yeah.
Oh.
Yes. Now, I'm glad you said it's C because it gives you an opportunity to learn and you don't make this mistake in the exam.
Okay.
You cannot convert it to term. You can only convert it to permanent insurance.
Oh, that's still a whole life,
The
yeah?
answer is B, yeah.
Correct.
Okay.
So the answer here is B. It's based on the ratio of men to women.
And women in the group.
Okay.
Oh, good.
Let's see, I'm trying to look for submit.
Yeah.
Submit.
Yes.
All right, so Clara, can you read that explanation for us?
Okay, yeah, sure. Group life insurance can be converted to an individual whole life, not a term policy. The group life insurance premiums are usually lower than those of an individual policy. The group sponsor receives a master contract, while the participants receive certificates of insurance. The cost of the coverage is based on the average age of the group and the ratio of men to women.
Okay. So that explanation has a lot in it. You answer about
tricky
3 or 4
question there.
questions. Yes. So very important. Let's go to the next and final one. To do us the honor of the final question, let's go to Mr. Desmond.
If an insured surrenders his life insurance policy, which statement is true regarding the regarding the cash value of the policy? A, it is not considered to be taxable. B, it is taxable only if it exceeds the amount paid for premium by 50%. C, it is only taxable if the cash value exceeds the amount paid for premium. D, it is automatically taxable.
Okay. Which one do we think is the answer here?
I think the answer is C.
Okay.
I'm inclined
C.
to agree with that.
All right.
C.
Okay, let's see if that is correct. That's correct.
Yeah, C. It is only taxable if the cash value exceeds.
And that's correct.
Only if the cash value exceeds the amount paid in premium. Yes, of course.
That's very good. Did we learn a lot tonight?
Yes, a lot.
Sure did.
Yeah, I learned a lot.
That's good. So
Mr. Valentine, I think the FX is probably where the exams come from. I would think, and how on the PSI, Prometric is different. What is the board that sets up exam FX?
PSI, right?
I honestly don't know which board set up which of the exams.
Okay, you gave a question. You gave two names before where somebody can call and buy a test.
Oh, you can register for a test with Pearson VUE. You can register with Prometric. I think there's a third one. And then you can register also, but you register through your state. It just depends on which vendor your state is using.
Okay. Yeah, my state is using
the best
PSI.
site. So which is the best site to take the pre-licensing? Is it Excel or because some of the questions I've seen here, I've not seen on Excel.
Okay.
That's correct. Exam FX is where the questions come from.
Okay, so this is what I'm going to say, Clara.
Yes.
I usually teach just to the material. I use the questions, but I use the question because for each question I use, I always try to teach about 4 other questions that can come in the exam. Some people prefer Excel. Some people prefer Exam FX.
So which one is the best? Which one do you think is the best?
I think the best one is the one that your SMD wants. Is the one that your SMD wants you to use.
I don't know. I just registered with PSI.
Yeah. I'm gonna be honest with you. Miss Clara.
Yes.
I use Exam.
Would you be angry if I did
one, I'm stubborn. And two, one.
Let's hear him out, please. Please hold on. Let's hear him.
I use Exam FX because one, I'm stubborn. I think that I can teach the class just as well through Exam FX. Though most people in our hierarchy in the business switch to Excel.
Yeah.
So I just think that I can, to me, it's how I teach and how you do the practice questions.
Oh, yeah,
That's
because Mama Stella told me to use Excel, but some of the questions I'm seeing here, which might likely be in the exam, is not on Excel.
And that's why
You're definitely correct.
And that's why I said the best app to use or the best platform to use is the one your SMD tells you to use.
Okay.
I'm going to teach you the subject matter is not different on Excel than it is different from Exam FX. So if I teach you the subject matter, and if in each of the questions we are facing, for example, we've done 30 questions, but I can tell you that we've addressed about at least 90 questions in the exam. So if I teach you that way, then you'll understand the material. 1, 2, you'll go past the exam.
The exam is trickish, actually.
Yeah, I know.
So how do you know the difference between Excel and the FSX?
These questions we are answering from FX are completely different from the ones you answer in Excel.
Oh, really?
And from my perspective, I do believe that the exams come from FX, Exam FX.
Okay.
And those who studied with the Exam FX may have greater propensity to pass at first
Oh.
test than those who studied with Excel.
With Excel.
Okay.
This is me saying
let
now.
me caution you. Some people think differently.
Okay.
I'm gonna be honest.
Mm-hmm.
Okay.
Yes, I'm gonna be honest. So I just want to be objective. Again, like I say, one of the main reasons why I use ExamFX is because I'm stubborn.
Well.
and I think I can teach you from both sides to go past this exam. And I'm going to tell you a little secret too.
Mm-hmm.
When I took this exam, guess how many days I studied for?
2.
1 week.
Reduce both of them.
3 days, 4.
Somebody
1.
said 2. I said reduce it from the best.
1.
1 week, 1 day.
I studied for 4 hours.
Oh my gosh.
Because you're smart.
Well, it's not just because I'm smart, but I was just from taking the bar exam.
Okay.
And when you take the bar, every other exam looks like piece of cake.
Exactly.
So it's the study strategy on how you attack the questions that matter to me.
Mm-hmm.
Oh, yeah.
Yes, and that's why each question we answer, I try to lecture around the questions, so that when the exam comes from any of those angles, you'll be able to attack it.
No, taking exams used to be a lot easier for me, but with the disability, disabilities, a lot of situations right now, even when we are answering the question, I felt that kind of scenario that I do in exam. But I'm going to take my time and keep going back and making sure I review very well before I go take it.
Coming from someone who wrote the life insurance exam and failed, it's not hard. It's just tricky.
It's just tricky, yes.
Yeah, because most of the questions you see on here is definitely what's going to be in the exam, but in a different way.
It's like they change it.
Yes, that's what I'm saying.
To trick you.
And most of the times, all the answers are correct. They just want the best answer, And that's just it. It's not hard because I always like have a 62, 65, just like few points to meeting up. Then I don't get it and all. And it can be frustrating sometimes.
Well, let me correct something, Clara.
Mm-hmm.
In most of the questions, 2 of the answers are going to be outrightly wrong.
Oh, yes.
2 of the questions are going to be possibly right. But what the exam is, what the examiners are looking for
is the
answer that speaks closest to the question.
Oh, okay.
Did you hear what I said?
Gotcha.
2 of the answers are outrightly wrong. That's why law of elimination, we eliminate 2. Then we are left with 2.
Mm-hmm.
And then 2 of the answers are possibly right. Of those 2 right answers, one of them speaks directly to the question.
Okay.
I'm going to tell you a little dirty secret also. If you get into the exam and you don't have any clue on the question what the exam is, go with answer B.
Oh, really?
Yes.
Like most of the times, is it correct though?
Pardon?
Most of the times, is it correct? The B?
Exam setters have a bias. It's been demonstrated scientifically to put the answer as B. Not all answers are going to be B.
Yeah.
But so if you get to a question where you are blank,
yeah,
and you don't know what the answer is, go with B. There are 3 scenarios of which answers you should go with. Okay, I'll give you the scenarios here. 1, the questions always test a rule. So if you know the rules very well, choose the answer that, if you amongst 2 answers, if you're not confused, choose the answer that is answering a rule. That's 1. 2, in most answers, if you are totally blank and you get to 2 answers, if you go down to 2 answers, choose the shorter answer. Why? Because examiners always have to throw in little loops to throw you off. So the shorter answer, when you get to two answers that are close, the shorter answer is more likely the answer. And number three, if you are totally blank or you have two answers that you don't know where to go with B.
Okay.
Yeah. I think that helps.
Those are some delineations on how to go past that exam. Dr. Omotola, any comments before we bring this to a close? Dr. Omotola is a co-lecturer in this class. And
apologies, I've been a little bit distracted, but I was listening from my couch there.
No, that's okay. That's okay. Any comments?
Yeah, I think I was hearing that people were like saying that Excel is better than ExamFX. Am I correct?
Yeah.
Okay, yeah.
Well, I don't have knowledge of Excel, but I know that I passed using ExamFX, and it has a very easy platform to learn. You know, if you just familiarize yourself with it, the video gallery and the video notes makes it very easy for you to learn. So I used this, and within 3 weeks, I was able to pass my test. So you don't have a bias.